why is this, I mean, so significant for us? We have seen this coming for a year now. We are in, this was finalized in September last year. Now it is June 28th, a year later. Why is this move so significant? Why is this inclusion so significant for us?
So, see, frankly speaking, government issues bonds every year, and already we have a strong domestic fixed income market in place. So till now, FIs were not compulsory buyers of Indian sovereign assets, but post this index inclusion, because they are also tracking the JP Morgan Emerging Market Bond Index, the global emerging market asset allocators will have to have an India allocation. And given the size of the guys who are tracking the JP Morgan Bond Index, which is close to $240 billion, and since India has got close to 10% weightage, that will bring in close to $24 billion into Indian fixed income market. So let's say from September, the announcement came in September 2023. From September 2023 till date, we have already seen some inflows into a market. And probably 20% of the flows have come, and 80% flows are likely to come from here till, let's say, March 2025. So from let's look that how much is, let's say, $25 billion, that is close to 2 lakh crore. And how much is Government of India borrowing this year on a net basis, that is close to 12 lakh crore. Right. So 2 lakh crore on 12 lakh crore is close to 1/6, which is close to 16%. So when you have more buyers to the tune of let's say 16% of your borrowing, that means that the total demand for bonds are increasing, and bond prices are likely to go up, and interest rates are likely to trend lower over the course of let's say next 3 to 6 months. If interest rates for Government of India comes down, the borrowing cost for corporates and borrowing cost for you and me will also come down. So the entire economy is likely to benefit because of this index inclusion. And basically, let's say if you are not any part of index, the FIs may come into your country when your macro is good, and the FIs may exit if they believe that the macro is likely to deteriorate. So without an index inclusion, we see relatively higher volatility in FII flows in fixed income market. With this index inclusion, the volatility would be relatively less. We'll have stable money. Apart from JP Morgan Bond Index, we have also been included into Bloomberg Emerging Market Bond Index, where also the flows are likely to be close to $3 to $5 billion. Now, based on experience of JP Morgan Bond investors, Bloomberg smaller index, if let's say we get included in the Bloomberg Global Aggregate Bond Index, that can also bring in close to $20 to $25 billion of flows. So for FY25, we have JP Morgan Bond Index. Probably for FY26 or 27, we can also have flows for, let's say, flows coming in from Bloomberg Global Aggregate Bond Index. So this is a very, very big positive. It's a positive for India. And a good thing, India macro is very strong and likely to remain strong for next few years. So a strong macro coupled with index flows is a positive for the Indian economy.
Mr. Agrawal, I'll actually, extend that notion that you brought up about fundamentals being strong. So, I mean, now that the Bloomberg index inclusion, which starts from January next year, 2025, and now the one that we are having today. So perhaps is there an increased confidence globally that Indian markets, the Indian economy, the Indian financials and fundamentals can actually, stand out? They have a greater stand-out now in the global setting. Is it right to say? There is greater confidence. Yes, that's what I'm trying to bring in.
100%. So global investors tend to reward economies where the macros are relatively better, and similarly penalize economies where the macro is deteriorating. So for last 10 years, what we are seeing is that the inflation has been under control. RBI has adopted inflation targeting framework from 2016 onwards, where RBI's mandate is to keep inflation in the band of 2 to 6% and an average inflation of 4%. And
Hmm.
let's say if we see the RBI commentary for last 15 to 18 months, they did the last rate hike in February 2023, and they have been staying on hold. And even if there are calls for rate cuts, RBI seems to be targeting 4% inflation. So, inflation targeting central banker gives confidence to the external world that if their currency is under control, their currency will also remain under control or remains more or less stable. So, one important factor is the inflation front. Second, fiscal deficit. According to our experience, this government has been a fiscal hawk. During
Hmm.
COVID times, the fiscal deficit was close to 9%, and the government
Hmm.
has taken efforts by consistently bringing down fiscal deficit from 9%. And for
Hmm.
in February 2024, they projected 5.1 fiscal deficit by 25, and
Hmm.
government continues to guide fiscal consolidation and guiding for 4.5% fiscal deficit for FY26.
Hmm.
Even with a relatively weaker mandate for the government this time, we believe that they'll continue with this fiscal consolidation process. And
Hmm.
the consolidated fiscal deficit of center and state put together will be close to 7% by
Hmm.
FY26. Now, 2 weeks
Right.
back, S&P has basically revised our outlook from stable to positive. And one of the
Hmm.
conditions laid down, or probably one of the preconditions for a rating upgrade, is a consolidated fiscal deficit closer to 7%. We believe that government is likely to work towards ensuring that the FY27, FY26 fiscal deficit is in the band of 680 to 7%, and
Hmm.
therefore it should result into, let's say, a rating upgrade over the course
Hmm.
of next 18 months. Third
Right.
point, let's say these index flows are current account deficit ranges anywhere between, let's say, 1 to 1.5%. Our
Hmm.
services exports have increased, which helps in bringing down the current account deficit.
Hmm.
The NRI remittances continues to remain strong, and in addition to that, we have index flows this year. So,
Right.
apart from, let's say, FDI investments or capital flows in equity markets, this year we are going to have 20 to 25 billion dollars on account of debt index inclusion. So, if
Hmm.
you have, let's say, a marginal balance of payment deficit or a balance of payment surplus, your currency is likely to remain stable. Again, stable inflation or lower inflation and a lower fiscal deficit is also going to help your currency. So, India macro,
Hmm.
all the parameters from by which you look at Indian macros continues to remain strong. And if you look
Hmm.
at the developed worlds, let's say in US, yes, the interest rate differential between India and US has narrowed considerably. In
Hmm.
calendar year 2022, our average inflation was lower than US consistently for
Hmm.
the full year, which we have not
Hmm.
seen for last 7,500 years. Again,
Right.
going ahead, it looks like that the interest rate differential between India and US is going to remain low, which
Hmm.
will continue to put relatively lower pressure on the Indian currency. Plus,
Right.
looks like uh, the the outlook of investors globally seems to be that probably over a long term, US currency is likely to remain under pressure, and therefore there
Hmm.
are investors who are now looking at who want to reduce their dollar asset allocation, and they are looking
Hmm.
for opportunities across the world, including emerging markets, where they believe that the macro story is strong and likely to
Hmm.
remain strong for a certain period of time.
Right. Uh, Mr. Agrawal, I mean, we touched upon the story as we head into this inclusion on how it looks like. But I mean, when I started, I mean, my starting note was about the fact that foreign capital was coming. There is increased confidence. We have a stand-by and everything. But I mean, when we talk about foreign flow coming in and everything, obviously this is not going to happen overnight. There is going to be some time, and now we have another inclusion that is supposed to be initiated from the January next year. So how is it looking in, I mean, considering these ambitions of getting more foreign capital, I mean, an increased stature in the in international financial market, how is it actually going to shape out in the shorter term and thereby in the longer term? When can we actually reap the real benefits of it?
See again, we are already reaping the benefits. Basically, if you see our we have a strong macro in place, and let's say the if you see from March 2022 till date, because of worsening outlook in US, basically the US central bank had to raise rates by close to 525 basis point, and in India the central banker has raised only rates by close to 250 basis point. Now, typically, when have we seen in past so many years when let's say US is raising rates by 500 basis point and emerging market is able to survive with a 250 bips rate cut? So it is due to the improving macro, which is a result of good work done over the last let's say decade, where India is reaping benefit. So one thing which we need to remember is that probably we had let's say the world was witnessing a lower interest rate regime for a long period of time, let's say from 2008 till 2022. Somehow interest rates globally has gone up, whereas interest rates have not gone up significantly in India. So relatively, we have already seen a lot of benefit due to our improving macro. And so currently, let's say if you look at the 10-year cost of borrowing for a US government is close to 4.3%, and the 10-year cost of borrowing for the Indian government is close to 7%. So the spread is close to 270 basis point. In March 2022, that spread was close to 500 basis points. So the spread, there has been a narrowing of borrowing cost between, let's say, US government and Indian government. And if there is a narrowing of interest cost between, let's say, and Indian government and US government, that benefit is actually been received by each and every individual and each and every corporate in India as well. So we have received a lot of benefit in terms that interest rates in India did not, let's say, if our macro would not have been good, probably our interest rates would have been even relatively higher than what we are at the current levels. So since we have achieved a good compression of spreads, we believe that the government will continue with its policy on the inflation front, on the fiscal deficit front, and the benefit is we have received a good amount of benefit in the last 2 years, and gradually will continue to receive the benefit. One shouldn't look at absolute levels of yields. One should look at relative differential between India and US. And if this differential continues to compress, that means Indian economy and all the stakeholders of the Indian economy are actually benefiting from this improving macro. With respect to our view, we believe that the 10-year G-Sec yield, which is currently at 7%. So we believe that the global interest rate hiking cycle is over. US Fed is also likely to cut rates by 100 basis points from here till December 2025. So over next 18 months, we expect US Feds to cut rates by around 100 basis points. And similarly in India, over the course of next 1 year, we expect close to 50 basis point rate cut. Again, government and RBI will like to ensure that we have a strong macro in place, and therefore we don't expect more than 50 basis point rate cut. With the view of rate cuts, with index flows, we believe that long-term yields in India are likely to trend lower over the course of next 3 to 6 months. And probably 1 year down the line, the long-term yields in India could be lower by 50, let's say 25 to 50 basis points from current levels.
I see. Right. I mean, a lot of questions perhaps, and I mean, we'll wait for trends to emerge, for things to emerge. But thank you so much for your time, Mr. Agrawal. As I said, we'll actually wait and I mean, see how things pan out, and we'll trouble you again for some more perspective. But thank you so much for your time today.
Thank you. Thank you for having me on your show. Thank you.